Imagine waking up to this headline. Bitcoin dumps. AI stocks follow. Global markets flash red. Your portfolio? Bleeding. Your confidence? Shaken. Your future? Suddenly uncertain. But what if I told you? Bitcoin falling first is not random, it's a warning. A signal. A pattern we've seen before. And right now, it's pointing to something much bigger. Stay with me, because what's happening beneath the surface is far more important than one bad red day. This might be the moment future millionaires look back on and say, that's when everything changed. Also, yes, I promise to make you laugh at least once. We all need it right now. You don't need to love Bitcoin. You don't even need to own it. But you must understand one thing. Bitcoin is the most liquid risk asset in the world. It trades 24/7. It never sleeps. It reacts before every other market, stocks, bonds, housing, all of it. Which is exactly why every major correction in the last decade started the same way. Bitcoin moves first. Everything else follows. Research from the IMF, Fidelity Digital Assets, and Glassnode all show the same thing. When investor confidence drops, the easiest thing to liquidate is Bitcoin. It's the canary in the coal mine. The first light to go out in a storm. So the question isn't, why is Bitcoin falling? The real question is, what storm is it reacting to? Now here's where the story gets interesting and uncomfortable. For years, analysts have studied Bitcoin's repeating cycles. Not magic. Not prophecy. Just human behavior repeating itself. And like it or not, Bitcoin just broke below its 50-week moving average. Every cycle where this has happened, the bull run ended. A prolonged correction followed. The historical average? Around 364 days of downward or sideways pain. Why does this matter? Because markets are social systems. Patterns form because human psychology forms them. When a key technical level breaks, the signal is loud enough that even institutional algorithms sell automatically. You might be thinking, okay, but if everyone knows the pattern, shouldn't it fail? You'd think so. But markets don't break patterns just because we want them to. Humans are weird like that. This is like saying, I know pizza makes me gain weight, but this time it won't, because I'm aware of it. No, it still will. Markets are the same. But this technical trigger is only the spark. The real explosion comes from the next part. Let's talk about the force powerful enough to move every market on Earth. Liquidity. When global liquidity rises, risk assets soar. When it falls, nothing is safe. Not Bitcoin. Not Nvidia. Not real estate. Not your 401k. Right now, multiple academic studies, from the Bank for International Settlements, Charles Schwab, and Morgan Stanley, show a sudden tightening in the system. And strangely, Japan is the trigger. Yes. Japan. I know. That one country we only talk about when we want sushi or anime. But for decades, Japan was the world's free money fountain. Zero interest rates. Negative interest rates. The ultimate borrow for nothing, invest anywhere machine. This created the famous yen carry trade. Borrow cheap yen, buy US assets, profit easily. But Japan raised rates. And just like that, global liquidity flipped. Hundreds of billions are being unwound. Dollar assets are being sold. Money is returning home. This is why markets are suddenly unstable. And Japan isn't the only one. Here's something most people missed. The Federal Reserve announced it's ending quantitative tightening, QT, on December 1st. Normally, this is bullish. But historically, ending QT has only happened when something beneath the financial system is cracking. In 2019, it happened right before the repo crisis. In 2020, it happened right before the pandemic crash. Ending QT is the Fed's way of saying, We see something breaking. We won't tell you what. Investors understand this. And they do what they always do. They run away from risk. Bitcoin sells off. AI stocks sell off. Semiconductors sell off. Growth stocks sell off. The domino effect begins. But macro and technicals only explain half the picture. The next part is psychological, and honestly, the most shocking. Behind the scenes, the Bitcoin community has been fighting a quiet, but very real, identity crisis. What is Bitcoin? Money? Data? An immutable archive? A digital hard drive? A recent code update expanded the amount of data you can attach to a Bitcoin transaction. This allowed images, videos, random files, even NFTs, to be permanently written onto the chain. But this creates two problems. 1. It bloats the blockchain. Running a full node becomes harder, decentralization weakens. 2. It exposes Bitcoin to legal and ethical attacks. Because data on the chain can never be deleted. If someone uploads malicious content, it lives forever. Some long-term holders see this as an existential threat. A reason to sell until the dust settles. Is this the main cause of the sell-off? Probably not. But in a fragile market, every fear matters. And speaking of fear, there is one more theory, and it ties the entire story together. This theory comes from portfolio managers who manage billions, and it's brilliant. Their argument is simple. Bitcoin isn't crashing. Early investors are cashing out for the first time in history. Before ETFs and institutional liquidity, a whale selling $3 billion would nuke the market. Today, ETFs absorb the selling. Governments buy the dip. Institutional flows stabilize price. This allows early holders, the same people who bought Bitcoin at $5, $50, $500, to finally exit without destroying the market. You know, like a company going public. Early shareholders cash out. New investors buy in. This phase can last a full year. In other words, Bitcoin isn't dying. It's transitioning. But the transition is painful, and everything around it is correcting at the same time. Here's the truth. Corrections feel like crashes. Until you look back at them a year later. Every major bull market, in stocks, crypto, housing, has one moment where fear takes over. This is that moment. But research-based investing is clear. JP Morgan, corrections and tightening cycles are normal. Vanguard, staying invested beats timing the market 94% of the time. Fidelity, missing the best 10 days destroys long-term returns. You win by surviving. You build wealth by staying consistent. And right now, survival equals discipline. In full transparency, I'm not selling Bitcoin. I'm not selling stocks. I'm not touching long-term positions. I'm continuing to dollar cost average. Why? Because the biggest long-term wealth transfers in history happened the same way. During fear. During uncertainty. During corrections. Ask yourself, will AI disappear? Will Bitcoin disappear? Will the US economy disappear? No. This is temporary pain. Temporary confusion. And temporary fear. The kind that makes people rich if they stay rational. Everyone wants the S&P 500 to go straight up. But it can't. Markets need to reset. Flush out excess. Shake out weak hands. This is not the end of the bull cycle. It's the cleansing before the next chapter. And history has a message for you. Bull markets reward patience. Bear scares reward preparation. Which side are you on? If you take one thing from this entire video, let it be this. Selling in fear builds regret. Investing through fear builds wealth. What's happening right now is not random. It's not the end. It's not the collapse of everything. It's the beginning of the transfer. From the impatient to the patient. From the emotional to the disciplined. From the panic to the prepared. You get to choose which group you belong to. If you want more research-driven explanations like this, the kind that help you protect your money and build wealth for the long term, then Backhand Index Pointing Right, smash the like button. Backhand Index Pointing Right, subscribe. Backhand Index Pointing Right, and share your theory in the comments. I'd love to hear your thoughts. And I'll see you in the next video. Stay safe, stay informed, and stay patient.